Welcome. Welcome to the annual meeting of your San Diego City Employees Retirement System. The big news today is you, the current employees and retirees of the City of San Diego, the Airport Authority, and the Port of San Diego. We're here to share why and how your pension system is secure and on solid footing to pay your future benefits. So let's introduce ourselves. I'm Cynthia Queen, the Member Services Director. How many of you here are currently working for the City of San Diego? Hello. Thank you for being here. How about working or previously working for the port or the airport? Excellent. The rest of the team told me that they were going to watch the video, so thank you for representing. Now, will you please raise your hand if you are retired from the City of San Diego? Woohoo! And a member of a retiree association? Excellent, excellent. We have a few folks here from the retiree associations I'll introduce real quick. We have the president of the Retired Employees Association, Jim Barras. Hooray, Jim. Woo-woo! We have the president of the Ask Me Local 127, Joan Hernandez. And I know we do have some retired police officers here. I'm not sure if we have any of the officers from the Retired Fire and Police Association, but we work closely with all of these groups, meeting with them regularly and listening to their input. So I would encourage you to work with them because they really do pay close attention and look out for you. So we're here today to make sure that you know what's going on. So to do so, I have assembled the world's leading team of experts. I would like to introduce to you Marcel Voorhees-Rossman, who is our Chief Benefits Officer. Liza Krisafi, our Chief Investment Officer. And in this corner, our Chief Executive Officer, Mark Hovey. And now, I would like to direct your attention and welcome to the stage the President of Sdcers Board of Administration, appointed by the mayor and exceptionally qualified to keep this system on track, Mr. Valentine Hoy.
Thank you, Cynthia. Welcome, everyone, and thank you for being here. I understand the turnout has been larger in prior years, and I think that's good news. It means everybody's calm and collected and not as worried as maybe they once were. So for those of you who are new to watching board meetings on TV, I'm sorry to hear that. We do play our board meetings live, and they're available on the website. And if you're not watching it, you're missing something very special and very interesting and better than Game of Thrones. So I encourage you to tune in. My name is Val Hoy, and I have had the pleasure to serve as a trustee since 2011 and was recently elected president by my fellow board members, for which I'm very appreciative. So the first thing you probably wonder is, why am I a trustee? Well, I need the money, and it's been good. No, seriously, I'm a volunteer trustee, as all of your trustees are, from the mayoral appointees. And I think I can speak for everyone in saying we do it to give back, but we also do it because it's fun and it's interesting. We meet interesting people, we enjoy one another, and we enjoy the education that we get from the process. And speaking for myself and my fellow trustees, I think we all feel that we have something to contribute, something important to contribute to this system, and really appreciate the opportunity to do it. So from my perspective, you don't owe me any thanks for doing this. I owe you thanks for the opportunity to serve and to have fun and to learn and to contribute. We're very fortunate in the City of San Diego to have a majority of our Board of Trustees appointed by the mayor and confirmed by the City Council. These are folks who have no stake in the system. They're not former city employees. They're not entitled to any pension benefits. But it's important that we be involved because we have no stake in the system. We're objective, we're neutral, we're outside the system, and many of our trustees have great depth of knowledge and experience in finance, in law, in accounting, and in other fields that they bring to bear as trustees, and it makes our system much stronger. So we're all about making sure that the system is on a sound actuarial footing and that it's serving you the way that it should serve you. Doesn't mean we're perfect, and if you watch our meetings, you'll know that we're not perfect, But we're doing our best, and we're doing it all in the interest of the system and not in anybody's individual interest. We also have balanced on our board 5 elected representatives, and those are people that different constituencies of the membership, retired and active, elect to those positions. This is also important because it gives us balance, it gives us information, it's a great conduit of information from you to us and from us to you. But I do want to say one thing, that pension board members are not like politicians. They don't represent a constituency when they vote on our board. All of us, including the elected members, have fiduciary duties to the system, which require that we act only in the interests of the system as a whole and not in the interest of any group. So if you get frustrated with your elected representative or someone else's elected representative for that matter, please understand that they're not there to serve a constituency that elected them. They are required by law and by a very strict fiduciary duty to only have the interests of the system as a whole in their minds when they cast their votes. So I just want to make sure everybody understands that. What's the job of the board? Well, the board's function is to provide guidance at a policy level, at a very high level, to the staff, the outstanding staff that actually implements that policy. And the board's function is to act for the best long-term interest of the pension fund system, not to make things easier for plan sponsors. And I'm very proud and happy to tell you that, at least since I've served on this board since 2011, the plan sponsors, not one of them, has ever once attempted to influence any decision by our Board of Trustees. And I think that's outstanding. Now, you're going to hear in a moment from our CEO. I want to say that it has been an honor to work with Mark Hovey for these past several years. He is an outstanding CEO. As many of you know, Mark has announced that he will be stepping down. He's going to be stepping down in early January. And I want to say a few things about Mark. First of all, I think you probably all know Mark, but Mark is not flashy, selfish, arrogant, insecure, or any of the other things that some of our leaders are these days. I've described Mark as an Eagle Scout, and I think that's an apt description. I read somewhere that an Eagle Scout is trustworthy, loyal, helpful, friendly, courteous, kind, obedient, cheerful, thrifty, brave, clean, and reverent. All right, apparently we have some scouts out there. So in my mind, that describes Mark almost. Because Mark is also honest, humble, careful, reliable, and he enjoys a good beer. So on the eve of Mark's retirement, I want to be able to say, and I can say without reservation, that Mark the Eagle Scout is leaving our system better, stronger, and much more secure than he found it. So thank you, Mark. You're also going to hear from Liza Christofi today, our Chief Investment Officer, and Liza's had a very good year. The system's had a very good year. You've had a very good year. And we've had some eye-popping returns. We've outperformed benchmarks, which is even a better gauge of how well our investments are being managed. And we need to celebrate those up years for sure, but we shouldn't be foolish enough to believe that the strong returns will carry on forever. We all know that there's fluctuation, there'll be down years, and the good news is that under the leadership of our CEO, CIO, and other outstanding staff members, including Marcel, Sdcers has become actuarially stronger over the past few years. Our funding ratio is very important, as you know, but the actual number in our funding ratio is not as important as the trend. 10 years ago, the city's funding ratio was in the bottom third of all public pension systems in the United States. Today, we're in the top half. And the city's funding ratio is improving at a faster clip than what's going on nationally. And that trend is more important than any number that you're going to hear. And that improved funding ratio has occurred despite the fact that Sdcers has the most conservative funding assumptions of any plan in California. And here's the really great news. It also happens in spite of the fact that our members are living longer than anyone ever expected, as you probably know. So if we were to adopt the same kind of funding assumptions that many other systems in the United States have that are not as conservative as ours, our funding ratio would look even better compared to theirs. So one thing that I can tell you is that if we stay on our current course over time, you can see Sdcers' funding ratio continue to rise and overtake many of those other funds that currently show a better funding ratio than we do. Now, I want to say one last thing about the board before I turn over the podium, which is that our board members don't always agree on every vote. We have a range of views because we have a range of perspectives on every issue. We really struggle when it comes to dealing with pension fund benefit mistakes. And if you've tuned into the TV, you know that. But one good thing that I can say about our board is that we have respectful and robust discussions of every issue of importance. And we are absolutely transparent in all of our decisions. You can see why we made our decisions. You can see who believes what. It's all out there for everyone to see. And I'm very proud of that. So thank you for being here today on behalf of the Board of Trustees. And thank you for everything that you do to make our pension system stronger and for your efforts to be and remain educated about your pension system. Thanks.
Thank you, Val. Your service is greatly appreciated. And thank you for reading my board report. We've prepared a presentation that we believe will provide you with all the news you need to keep you up to date. And I think we're going to take the full hour that we've allotted here, but I promise to get you out by lunchtime as promised. If you do have a follow-up question or some type of a question that you think would be of interest to the whole group, we do have note cards that you can write your question on. We have Lee Paravano over here. If you need one, once we get going, then you'll just raise your hand and Lee will help you. We also have on this side, Michelle Wagner-Malecki. And we have Sandra Clausen as well in the back. Again, I think we'll do a good job. Now, some of you may have come for a personal question for yourself. Understand. So if you'll just on that card, please write your name and contact information so we can make sure that we can take care of everyone today. We'll do that. All right, thank you. Now I have a question for you. To introduce the content of our presentation today, we'd like to take a live opinion poll using text messaging via your cellular devices. Now, don't worry about this if you're not interested in doing it or if you've just arrived. Most of you, we've walked around beforehand and we have you set up. So you folks will go back to the text message that you have already received your confirmation from. And when you answer, you're going to hit A or B to respond. All right, so let's take a poll. When you contact Sdcers or register on the member portal, why are you required to answer a series of questions before you can access your retirement account? You will text A if you think the answer is, we want to get to know you better, or B if you think it's because these steps are essential to your data security. Go ahead and text A or B, whichever you think the answer is. I thought there'd be someone who wanted to get to know me better. I already know all of you very well. Excellent. I'm so pleased to hear that you're feeling the same way we do about this very important topic. So now, let me know afterwards. So now, I'd like to introduce you to Marcel Voorhees Rossman, who will tell you more about this important topic. Thank you.
Good morning. What do Yahoo, Deloitte, Equifax, Verizon, Chipotle, Bell Canada, Virgin America, TSA, and the CIA all have in common? Every one of those has reported a security breach within the last 12 months. There are 7.3 billion people in the world, and 3.2 billion accounts were compromised in just those security breaches. According to FBI Supervising Special Agent Brian Abalera, 70% of data breaches are caused by human error, as were most of those. So, what is Sdcers doing to help protect your data? As Cynthia mentioned, when you go to set up an account on our portal, or when you call in, you're going to get asked a series of questions that are unique to you. We're doing this so we can make sure we're giving the information to the correct person who's authorized to get that information. We realize it can be a pain, but this really is to protect your data and the data of your fellow retirees and members. We also have limited what you can put on an email attachment, so we only allow PDF files to come in through emails. That's to help protect us against viruses that are embedded in other types of attachments that come through. In addition, we limit staff's access to your data, so only staff members who have a need to see your data are able to see it. And then we provide ongoing, recurring training to those members or to those staff people to make sure that they are being careful with your data. And finally, from a system perspective, we use firewalls and multi-factor authentication to help protect your data as well. So now you know how we're protecting it. How good of a job are we doing at protecting it? Every week, Department of Homeland Security conducts a scan of our external website. If they were to find any significant issues, they would contact us immediately. I'm happy to say in all the weeks we've been doing this, they have yet to find a significant concern with our external website. We also hired a firm to come in and do an information technology risk assessment. While they did have some suggestions and comments that would help strengthen our internal controls, there were no significant findings. One of their suggestions, which was already on our radar to implement, is to have a penetration test. That's going to happen sometime this year. It's a secret. Staff doesn't know the date or the time, so we can make sure we really see how good our defenses are. So that's how we're protecting your data and verifying that it stays protected. What do we do in a case of emergency when we need to get to your data? Sdcers has a very robust disaster recovery plan. We review it on a regular basis, we update it, and we practice it. This year, this last March, we used our disaster recovery plan to process retiree payroll. That means all the staff involved in processing it, payroll division, benefits division, our investments division, none of them had access to their computers in their offices. They had to do it with our disaster recovery plan. And it was seamless to all of you. So we can't promise it will always go that smoothly, but we are committed to making sure that we can pay you as quickly as possible in the event of a disaster. Now I'm going to switch gears and talk about something that's been in the news quite a bit lately, healthcare. While Sdcers does not determine the healthcare benefits that you may get as retirees, we do work very closely with all three of our plan sponsors to help facilitate those retiree healthcare benefits. The City of San Diego's Risk Management Department determines what healthcare plans are available for you to sign up for. In addition, our retiree organizations work together to create SDPBA, which also offers retiree healthcare programs and other types of retiree insurance programs. We're quickly coming upon a generation of retirees who have no retiree healthcare benefits. So I want to make sure that our City of San Diego retirees understand, even if you don't have a retiree healthcare benefit from the city, you can still use any of these healthcare products through Sdcers and have the payments come out of your monthly check. This is even if you don't qualify for any type of reimbursement. So, was there anything else you guys were wondering about today? The staff is going to suggest to the board, or report to the board, that we recommend they pay 13th Check and Corbett once again this year. That'll happen at our November board meeting. That is great news. And now I'd like to bring up our Chief Investment Officer, Liza Krisafi.
Good morning. Good morning. So this morning I am going to give you an overview of markets for the last year, Sdcers performance, and I'm going to cover one of our key action plan items that we completed during the course of the year. This first slide shows you returns for a variety of asset classes. And as you can see, most of them were positive and a fair number of them were strongly positive. In the US, stocks were up strongly, and that was driven largely by gains in technology stocks, which were up about 35% during the year, and financial stocks, which were up 27% during the course of the year. Also in the US, small cap stocks were up almost 25%. And this is largely a function of the fact that we have solid GDP growth in the country. The economy is growing around 3%. We have low unemployment, under 5%. And we have low inflation, under 2%. And that's a very solid base for economic growth and for the markets to move higher. Outside of the US, we've seen recovering returns in non-US markets. In developed countries, we've seen improvement in the Eurozone, a strengthening partnership between France and Germany, which is helping the Eurozone. And also in Japan, they're seeing the strongest economic returns they've seen in decades, and their economy is growing around 4%. And then China, which is one of the largest emerging market countries, is still chugging along at a 6% economic growth rate. Fixed income was the only area, US fixed income, where we saw slightly negative returns. And that was a function of the fact that during the course of the year, interest rates moved up. For example, the 5-year Treasury note started the year with a yield of 1.2% and ended the year at 1.8%. When interest rates or yields go up, bond prices go down. And then you can see towards the bottom of the slide, there are a couple bars there with positive returns. That's emerging market debt. And the last one, the NCREIF Odyssey bar, is a measure of real estate. So those are still good, solid returns. So overall, a very positive year for a lot of asset classes. This isn't something that we normally see. Usually you see a mixed bag where you have some asset classes doing well and others that aren't doing so well. So how did we do? 13.5% for the year, net of fees, versus our benchmark of 11.3%. So very strong returns on an absolute level, but also very strong returns versus the benchmark. As you can see, the 3- and 10-year numbers still are quite a bit lower than that. The 3-year number is a function of the fact that the 2 years prior to that, we actually had subpar returns. And that's where we had asset class returns more of a mixed bag. Especially we saw weakness in Europe, last year with Brexit, the year before with a Greek default, and weakness in emerging markets. And then of course the 10-year number also still includes the results of the global financial crisis that occurred in 2008 and 2009, when we saw a decline of around 24% over those 2 years. But longer term, you see the since inception number, which is about a 29-year return, is still very strong at 9%. This next chart reflects historical market values. We like to call this the mountain chart. We're climbing the mountain. And we ended the year at $7.5 billion, which is the highest level that we've ever seen in the fund. And just to put that in context, during the depths of the global financial crisis, when we had that big market meltdown, the bottom of the market was in March of 2009, and the value of the fund actually got down to $3.2 billion. So we have had remarkable growth coming out of that, even with some subpar returns. And then in the last couple of weeks, we've recently closed in over $8 billion in asset values. So this next chart looks at the peer universe. We want to compare ourselves to our peers. And this universe includes about 400 other public pension plans. Our return of 13.5% puts us in the top 18th percentile compared to our peers. That means that we outperformed 82% of our peers. And you can see that that first bar for last year is broken up into quartiles. And that just shows you the range of returns for the year. So the top performing fund during the year was up 14.9%, and the lowest return was 7.3%. So quite a dispersion of returns. Now, how did we outperform 82% of our peers? Couple things. One, we have an overweight to small cap stocks. That helped us this year. We also have a greater exposure to international stocks than our peers. We have about 60% to 40%, 40% in international, compared to our peers, which only have about 25% of their equity exposure in international stocks. Also, in the alternatives category, which includes things like private equity, real estate, and infrastructure, we did not have any exposure to hedge funds. And hedge funds did not perform nearly as well as some of those other categories. And finally, in the fixed income area, even though that was a low returning asset class, we have a lower weight in fixed income than the majority of our peers. So you can see over longer periods of time, we're always shooting to be in that top quartile. And for the most part, we are, with the exception of the 10-year number. And then if you look very long term, we're above the 10th percentile for the 20 years. And since inception, we're actually, for 20 years, we're in the top 2nd percentile and the top 8th percentile since inception. So very strong performance versus our peers. Some of the highlights for the year. As I mentioned before, we had a very strong year for stocks. And our outperformance versus the benchmark was really driven by active investment management. So managers that we've hired who are striving to outperform their benchmark. We had one large cap value manager that actually outperformed their benchmark by 13%, which was extraordinary. And that overweight to small cap stocks that I've mentioned helped as well. In the broad market index, small cap stocks make up about 10% of the index. Our weighting is 15%. Some years that helps us, some years it hurts us. This year, it helped us a lot. In the fixed income area, as I mentioned before, returns were slightly negative, although 2 of our active fixed income managers actually outperformed their index and generated slightly positive returns. In real estate, returns have moderated to a more reasonable level at an 8.2% return, and then private equity is still just rocking and rolling and turned in an 18.5% return for the year. So strong performance in a lot of categories and outperforming the benchmark. So this list is some of the key action plan items that we covered during the fiscal year. Most of these are operational in nature, so I'm not going to cover all of them. But I would like to talk about the last item, review of risk-adjusted returns. Staff worked with our general investment consultant, Aon Hewitt, to look at our risk-adjusted returns compared to our peers, compared to benchmarks, and looking for improvements going forward. The first phase of this review involved looking back on a historical basis. So we looked at historical returns versus our peers for 3, 5, and 10 years. And what that showed us is, as we saw earlier, we had better performance than our peers. Then we also compared our current allocation looking forward to compared to our peers. And we also appeared to be well positioned because we have higher allocations to real estate, infrastructure, which is anything from a highway, a toll road, to an airport. It could be the desalinization plant in Carlsbad, which we're actually an investor in. And we have a higher allocation to emerging market debt. And those asset categories have higher expected returns and lower risk. So that's positioned us well going forward. The second phase of that review involved looking at performance versus the benchmark. And in the last couple of years, we had identified a number of strategies and managers that were underperforming. And we brought those to the attention of the board. They took action and terminated those strategies. And that has resulted in improved performance in the more recent period. And then finally, we're always looking forward to see, are there other strategies or managers that we can add to the portfolio that are going to improve our risk-adjusted return? And an example of that is last November, we hired Allianz Global Investors for an options trading strategy. And this strategy can outperform whether the market is up, whether it's down, or whether it's sideways, or there's a lot of volatility. And for the 10 months that we have had that strategy in the portfolio, they have outperformed their benchmark, which is the S&P 500, by over 4.6%. So those are the kind of things that we're looking for. And then finally, This is our asset allocation as of the end of the year. And as you know, on an annual basis, we do an asset allocation review. And we did not make any changes this past year. We actually haven't made a lot of changes in the last few years. We think we're very well positioned in terms of both domestic and non-US stocks and bonds. We have a healthy allocation to alternative strategies in private markets, like private equity, infrastructure, and real estate. We also have created an opportunistic bucket, which is showing a 3% allocation here. And this allows us some flexibility. And what we're really looking for here is interesting strategies that can either add diversification to the portfolio, can provide additional return, or sometimes are just a function of a dislocation in the market. We currently have some real estate debt in that bucket, which is expected to earn 10 to 12%. And we have a couple of opportunistic debt strategies where the managers are investing in US and non-US debt that banks have to shed off their balance sheets because of regulations like Dodd-Frank and Basel III. So that gives you a snapshot of where we're currently allocated. That concludes my comments, and I would like to turn it over to our illustrious CEO, Mark Hovey.
Thank you, Liza. Well, this is our 10th annual meeting. It's hard to believe we've had 10 of these already. Anyone here been to all 10 of our annual meetings? Thank you very much. How about 5 years? Anyone been here for 5 years? Well, it's been a number of them, and it's a pleasure to hold these meetings each year, and it's a pleasure to come and talk with you about what's going on in the pension system. Before I get underway, though, I'd like to ask you a question. And if you still have your cell phones handy, it's another one of these little fun and game things. So the question for you is, Sdcers was recently in the newspaper saying that we were putting off the pain associated with pension debt. Is this good news, A, or is it bad news, B? So if you still have your cell phones out, enter A or B in the message and hit send. Could you repeat that question? Absolutely. We were in the newspaper last month saying that we were putting off the pain with new pension debt. Is that A, good news, or B, bad news? Well, most of you think that's good news. Few of you think it's bad news. Good. Well, enough of that. That's what I really want to talk with you about today. I, 2 years ago, told this group that we were not in the news anymore. I was feeling a little bit smug about the fact that things were going so well, no one wanted to talk about us. Well, and then there was a retiree that many of you know, Joe Flynn. He said, Mark, your board meetings are now getting over at 11 a.m. They used to get over at 11 p.m. They're going way too fast these days. So imagine my surprise when on September 8th, the San Diego Union Tribune had a headline on the front page that said, San Diego putting off pain with new pension debt. Well, I don't know about you, but I don't like reading about my retirement system on the front page. I normally think it's bad news if we're on the front page. Well, it was not bad news, it was good news, and that's what I would like to talk with you about today and share some of the facts. So what did our board actually do back in September that generated this interest? Well, the first thing they did is they lowered our discount rate, which is our expected rate of return on our investments. It's what we expect to earn on average over the next 30 years. We lowered it from 7% to 6.75%. And when you do that, that triggers more contributions coming into the pension plan from both the employees and the employer. Now, that was good news, and it was done to enhance the benefit security of our plan. That's why the board did it. But they also did one more thing that day. The second thing our board did was they changed the debt amortization schedule, which is another way of saying what our mortgage payments would be on our pension debt. They changed the payment pattern for our plan sponsors to make their contributions on a more consistent level basis year after year. And they did that based upon the advice of our pension experts, including our actuary, our outside fiduciary counsel, as well as our chief investment officer, all of which said it makes much more sense if the pension payments coming into the plan are on a level pattern over time. That's why they did these actions. And as you see up there, it enhanced the benefit security of our plan. So these actions not only increase benefit security, but they also support the Sdcers mission statement. Does anyone know what the Sdcers mission statement is? Well, I do. It's to provide accurate and timely benefits to our members and ensure the trust fund's safety, integrity, and growth. The board actions that day directly supported that mission statement. That's why the board took those actions. But you know, our actuary also has a set of objectives that they use to ensure that our fund is appropriately managed and funded. So this next chart shows you what our actuary showed as the 4 goals of an actuarial funding model. There are 4 circles on that screen, and I'll talk you through them. The top circle is the blue one, and that says benefit security. That's to ensure that all of you are getting your retirement benefits on a regular basis. On the left-hand side, that red circle says benefit sustainability. And what that means is we need to ensure that the pension payments that we're asking our plan sponsors to pay are within their budget, that they can afford to make those payments. A third goal, on the right is the yellow item, which is benefit stability and predictability. For those of you who have worked on a budget before, you know it's important to understand what your budget payments are going to be each year. And we have a goal of ensuring that those payments are very predictable. And then finally, the bottom circle, the green one, this has to do with something called intergenerational equity. And that means that the people who are paying into the plan are not the people that are deriving the benefits from the plan, or the people that are paying into the plan, and that we're not putting off pension payments to a future generation. These are the 4 goals of what that pension system actuarial funding model is. But I'd like to talk a little bit more about that top circle, which is benefit security. Benefit security is number 1. That's ensuring that you get your benefits paid. And best practices associated with achieving benefit security often mean that we need to lower our actuarial discount rate or our earnings assumption, which requires more contributions coming into the plan. It also means that we need to change our amortization schedules and make them shorter. And it requires higher contributions. Now, you may know that there are constitutional protections for your benefits. You know, they're going to be paid. The law says they're going to be paid. But you need to be mindful of how big the pension payments are that you're asking your plan sponsor to pay. If those payments get to be too big and the plan sponsor can't pay them, bad things could happen. And I would say that that's exactly what happened 5 years ago when San Diego taxpayers voted to pass Proposition B. They were concerned about the city's ability to be making their pension payments, and that's why the plan is partially closed. So I'm talking a lot about contributions and investment earnings, but is there a simple way to understand how all the funding comes together? Well, that's what this next chart will show you. This is our pension tank. And you will see in the middle there's this big tank with green. The green is the assets that are in the pension plan. The space above the green are the unfunded liabilities of the plan. At the top left, you see 2 blue pipes coming into the plan. Those are payments coming in from employees and the employers. And then on the top right, the yellow, that's investment earnings come into the plan. So those are the things adding assets, making the green go up. Making the green go down, of course, are benefit payments going out of the plan and the expenses to run it. Those are the red items at the bottom. So that's how the funding model works. Now you might be wondering, did we really need to adjust the investment earnings? After all, we've been doing a very good job with our investment earnings. And the answer is, we absolutely did. And the answer is risk. This chart talks about how to achieve an average 7.5% return year over year is requiring plans to take on an increasing amount of risk each year. I realize there's a lot of numbers up there that you can't really see, but on the right-hand side you see 3 bar graphs, and this shows you what a typical asset allocation is in a pension plan 20 years ago, 10 years ago, and today. The left graph is all the same color, all gray, and what that represents is that 20 years ago, if we wanted to earn 7.5% on our investments, all we needed to do was put all of our money in bonds, fixed income investments, which were paying 7.5% at the time. At the bottom of that column, you see a number 6. That's referring to the standard deviation, which is an element of risk associated with the plan. Over time, as interest rates have come down, you can no longer earn 7.5% by putting all of your money into fixed income. Some of you may be familiar with the 60-40 rule, where 60% of your investments would be in stocks and 40% would be in bonds. That's that middle column there, but you can see the risk at the bottom of the page has now grown to 8.9. It's riskier to be in stocks than just into fixed income. But if you go all the way over to the right-hand side of that column, now you see a column that's made of many, many different colors that represents many different asset classes. That's what you need to do. You have a much more complicated portfolio. But if you look at the standard deviation, the bottom number on the right, it's 17. That's almost triple the amount of risk today than 20 years ago to get that same 7.5% return. So we've really needed to dial down that risk. That's why we did it. So are we alone in dialing down the risk on our plan? The answer is no. The next chart shows you what's going on in the state of California. There are 40 pension plans in the state of California, and this graph shows you on the left-hand side, the first column, a dispersion of what all these 40 plans were assuming their investment earnings would be over time. You can see the red bar and the blue bar on the top represent more than half the plans, and more than half the plans 4 years ago thought they could earn 7.5% or more. Now, if you go across to the right-hand side, that shows you what's going on today, and the colors of the bars have changed, where the blue is almost gone completely. That's people that thought they could earn more than 7.75%. Now, the green and the purple bars on the far right-hand side, these are plans that now assume they're going to earn less than 7.5%, and that's more than half the systems in California. The bottom right corner of that right graph shows a little gray box. Those are plans that assume they're going to earn less than 7%, and that's where Sdcers now falls. So, I'd like to revisit what I was talking about at the beginning, and that is our board lowered our discount rate and they leveled out the pension payment plans, and some said that we were putting off the pain associated with pension debt. Is that really what happened? No, that is not what happened. This next graph talks to you a little bit more about that, and I'm going to zoom in on this a little bit. The top graph is showing you what the City of San Diego's pension payments are going to be into the pension system for the next 30 years. The gold bars that you see there represent what the city would have been paying had we left our actuarial assumption of earnings at 7% on average over the next 30 years. The black line that you see running through that is what now is the city projected payments based upon lowering the discount rate and smoothing out the pension payments over time. Is there much of a difference between that black line and the top of the gold bars? No, it's very much the same. In fact, you can see in the middle of that graph, the new plan that the board put in place is going to be asking the city to pay a little bit more than they used to, and then for the years 15 through 30 on the right-hand side of that graph, that's going to save the city $300 million over what they would have been paying before. I certainly don't think that's putting off the pain with new pension debt, and I certainly believe that's in the city's best interest. Now, the bottom part of this graph looks at funding ratio. And the funding ratio is a term that refers to the relationship of assets to liabilities in the pension plan. Today, the city of San Diego has about 71 cents of assets for every dollar of liabilities. That's on the far left-hand side. So the gold bar represents our old assumptions, and the black bar represents our new assumptions with that level smoothing. Is there any appreciable difference in those two lines? No, there really isn't. So board action was very much within their rights to ensure that we've got adequate funding into our plan for the next 30 years. So, with that, I would like to conclude with a few summary comments about your pension system. First of all, our assets have never been higher. Liza mentioned that at the end of the year we were at $7.5 billion. Today we're over $8 billion, highest it's ever been. Our long-term investment returns we've been talking about all day here, they are very solid. We're in the top decile over long term. Very good results. Val Hoy spent quite a bit of time talking about the diversity of our board, and that is a strength, very much a strength. We are the only plan out of 40 in California that has a majority of our board members independent of the pension system, ensuring the most objective decision-making possible. Our relationships with our plan sponsors, the city, the Port Authority, and the airport have never been better. We meet with them on a regular basis, not just me, but my staff does as well. We meet regularly with the retiree groups to stay in contact with you, to know what your concerns are. My staff knows that their number one responsibility is taking care of you. Focusing on our customers is what really is most important to them. So in conclusion, I wanted to share with you that I have really enjoyed being a pension system CEO for the last 10 years. It's been a lot of fun. I think in this next chapter, it's time for someone else to take a turn at running this. The board has formed a search committee, and we have now started advertising to find my successor. I can assure you the board's concern is that the transition to a new CEO will be as smooth as possible. I don't think we're going to miss a beat with the new board leadership. I think you're in very good hands with the board and the staff that are supporting us here. So thank you for supporting me. I've really enjoyed it, and most especially thank you for coming today and being engaged in your pension plan and asking good questions. Thank you.
Jessica, what's that next slide you had up there? Oh, well, Mark, here, you left this over here. Earlier, I thought it might be an Eagle Scout uniform, but that's wonderful. Thank you, fearless leader.
Retirees need a Hawaiian shirt, don't they?
Joe Flynn is our idol. He does great things. All right.
There we go.
Excellent. Excellent. You're welcome to wear that shirt for another almost 3 months.
There we go.
We still have work for you to do. Thank you, sir. Now that you're all informed, how are you going to keep up to date? I hope that you have all registered on our member portal. If not, I would encourage you to do so. More than half of our membership is registered. That's more than 10,000 people. As Marcel had explained previously, you will need to answer a series of questions, and that is absolutely to keep your data secure. Once you've created your account, I think many of you retirees know that that's where you go to look for your monthly pension payment detail. You can also update your beneficiaries, change your tax withholding, update your direct deposit. And for those who aren't yet retired, you can do detailed benefit calculations to find out what your future pension would be. And nowadays, you apply to retire online. You submit that electronic application, then you still come into our office for a personal one-on-one meeting where we have a full discussion, answer all your questions before you finalize your decisions. We want to make sure everybody's got their questions answered. And we do appreciate all your diverse membership. That's very important to all of us. People have different needs, different requirements. So we're here to make it happen for anybody, whether or not you have a computer or a flip phone. For my friends out there who told me that they had flip phones, we're here for you. Just give us a call on the old landline. We'll answer that phone. Now, thank you for staying engaged. Keep in mind that if you receive a communication from Sdcers, I do want you to read it, because I don't send junk mail. Honestly, it's something important about your taxes or about the plan we want you to know about. And I really encourage you to look into the retiree organizations. Jim, would you mind holding up the handful of brochures that you have there? The Retired Employees Association is open to everyone in all types of membership as well. And if you join REA, you'll get to see Jessica and I every month. Jessica Packard over here, our communications manager. So that right there is worth the monthly dues. Or, well, that plus Jim. Excellent. Okay. And of course, I want to encourage you to ask questions. I'm pleased that it seems we've done a great job of answering your questions today. You can always call us. You don't have to use the internet. We encourage you to do so. We do all these things to make it efficient. And of course, we have our office downtown where you can pop in and turn in your paperwork if you like to do it that way too. Now, if anyone has, I believe there were some folks who might have more of a personal question about their own account. If you'll just fill out one of these cards and put your name and phone number on it, we will be sure to get back to you with that information. All right? Now, I'd like to just give a couple thank yous. First of all, I want to thank all of you. I thank you for your service. I thank you for being interested, engaged, and for coming here today. I thank all of our presenters. I thank Jessica Packard for her excellent work in putting together the presentation. Our wonderful friends from City TV and Communications, Candace and Mike, who have made all this happen. With that, to remind you, there will be a videotape posted in another week or so once they do all the fancy editing to make sure you can see the slides. Thank you for those of you who were particularly interested in taking photos of the slides. If you like, by the end of the day today, Jessica will post the slides that were shown on the website. So if anyone would like to look at that and review them more closely, those will be available by the end of the day today. The video will take another week or so. But let your friends know who couldn't make it that they're welcome to find that information there. And lastly, I want to thank our fine Park and Recreation staff. I know we have some folks here who might not work in this building, but we appreciate all the effort that goes into having this meeting here. So thank you all very much, and we look forward to seeing you next time.